Welcome to my Forex class today. I'm teaching about supply and demand zones. So under technical analysis, supply and demand zones is one of the ways of analyzing the market and one of the trading strategies you can use. So what is supply and demand? Going back to economics, supply and demand is an economic term. So what is actually the law of supply and demand in economics? It says that if supply rises and demand decreases, price will drop. And if demand rises and supply decreases, the price will rise. It's a normal thing in life. Okay, let me use the Nigerian scenario for instance. When there was shortage of Naira notes, that is earlier this year, 2023, before the election, when there was shortage of the Naira notes, the demand, the cost of withdrawing the new Naira notes from POS was very high. But fast forward, because why it was very high is because the demand for the hard currency was high, was very, very high, and the supply was low. So the price rose automatically. So fast forward to after the election, 2-3 months after the election, when the currency is in supply, is in enough supply, everybody now has the money. So the demand is not that high again. The demand is not that high again, and the supply is equal to the demand. So the cost of withdrawal has automatically fallen. So this is a real life example of supply and demand. Now, how do we apply it in Forex? This is my chart of GBP US dollar, and I'm going to be explaining supply and demand with this chart. So how does supply and demand apply in Forex? In Forex, a supply zone is a zone where sellers are concentrated. Or let me put it this way, a supply zone is a zone where you have more sellers than buyers, or where you have more supply than demand. And what does that imply? Following the law of demand and supply, that means that the price will fall. Where you have more supply, excess supply than demand, the price will fall. Now, what is a demand zone? A demand zone is the opposite of a supply zone, where you have more demand than supply. Now, where you have more demand of a product than supply, that means you have excess demand from the buyers, from ready buyers, but low supply. What will happen? The price will automatically rise. So that is what we call a demand zone, a zone where you have a very high number of buyers with low sellers, or a zone where you have excess demand than supply. So in a demand zone, what happens? Since you have excess demand than supply, automatically the price will rise. Now, in the demand and supply zone, there are four cardinal points you need to note. This is just for theory's sake. The main thing is to know what is a supply and a demand zone, how to draw it, and how to use it to trade. So now let me show you the four cardinal points you need to note. From a demand and supply zone, you have the rally-based rally. Let me show you first. Okay, so from this demand and supply zone, there are 4 points. You have the rally-based rally, the drop-based rally, the drop base drop and the rally base drop. So for the demand zone, the rally base rally and the drop base rally occurs in a demand zone. So let's look at the rally base rally. That's the rally base rally. You can see how it's formed. This is the rally base rally. This rally base rally, you can see the price from the lowest points, or from a support, it rallies, the price rallies, drops to a base, and then rallies again. That is why it's called the rally base rally. So this point now will be a demand zone, since the price will be going up. You know that when there's a demand zone where you have more demand than supply, the price is to go up. So the rally base rally occurs in a demand zone. The next point that occurs in the demand zone is called the drop base rally. These are formations of demand zones. So let's look for the drop base rally. You can see the drop base rally here. Here the price drops, rises, draws back to the base, the starting point, and rises again. The difference between the drop base rally and the rally base rally is that in the rally base rally, as you can see, this is the rally base rally. The point does the dropping, or you can call it a consolidation or the retracement. In this dropping, it does not drop back to the starting point. But in the drop base rally, as you can see here, once it drops before rallying again to pass the initial point, it draws back to the starting point where it started originally. So these are rally base rally and the drop base rally of the demand zone. The opposite is what happens in the supply zone. Let's look at, in the supply zones, you have the drop base drop and the rally base drop. Let's look at the rally base drop. So you can see the supply zone is above because you expect price to fall from the supply zone. As I told you, the supply zone is where you have excess supply than demand. When you have a lot of products in your store and there's little demand for it, you are likely to drop the price. So that is just what happens in the demand zone. So as you can see, the rally base drop, the price rallies up, goes back to the base before dropping. Now let's look at the drop base, the second point, drop base drop of the supply zone. The price drops, does not return to the initial point, retraces to some level, and then keeps dropping further. So that is the drop base drop of the supply zone. So that is it. As I told you, those 4 points, the drop base drop, rally base rally, and drop base rally, are just for theoretical reasons for you to know. Now let's look at the practical application. Let's go back to our MT4. Let's look at the practical application now. So after we've identified the 4 major points which we just talked about, we are going to look at now, how do you identify the supply and demand zone? It's a very, very simple something. This is a Great British Pounds USD chart of a 1 minute chart. So I'm going to go to higher time frames. To go to higher time frames, I just touch this, I go up. So this is, I'm going to use the 15 minutes time frame. You can use the 30 minutes, you can use the 1 hour, but you don't use time frames that are too high so that the point does not become too big. So I already drew a demand zone here. I already drew a demand zone, so I'm going to remove it so as to show you how it's done. Now, how do you identify supply and demand zone? First of all, now remember, you said that these zones are zones. Like a supply zone is a zone where sellers are more than buyers. So that means in a supply zone, price is likely to fall, and a demand zone is a point where buyers are more than sellers. That means a demand zone will act as a support to push price upwards, because in a demand zone you have more buyers than sellers. So now I'm going to be drawing the demand zone where you have more buyers than sellers. That means if price touches the demand zone, it will bounce up. Note that supply and demand zones are not just line, they are zones or areas. So I'll be using the demand zone for my illustration, and this is a chart of Great British Pounds USD, a 15-minute chart. So now, how do you identify and draw the demand zone? Now, the demand or the supply zone, you look for, there are three ways. One, turning points. So turning points, okay, like this. Now look where I touch in the screen. The center of that is a turning point. That is a place where the market reversed. Let's look at another turning point. Yes, let me zoom in a little so that you can see the big picture. This is another turning point. The market reversed here. Here's another turning point. The market reversed there. So let me look for turning points up. You can see this is one turning point. The market's reversed here and started coming down. Look at another turning point here. Okay, here, yes, the market reversed here and started coming down too. So since we want to draw the demand zone, the turning points will be below. So number one way is turning points. So the turning points, now you look at, like for the demand zone now, as I'll be using the demand zone for illustration, you look at the lowest points that the market turned, and you look at the candle there, the lowest candle. You draw the demand zone between the beginning of the candle to the end of the candle. So I'm going to use this point for illustration. Now you can see, now this is, let's draw the demand zone here. So now the tools for drawing the demand zone, how do you locate it? You just touch any point of the screen, it will bring out this circle. You touch this arrow that looks like a triangle, a circle and a rectangle just before M1. You touch it, it will go to objects. You now select this plus. You can now see lines, you see channels, you see gun, you see Fibonacci. You still go down. Now shapes, you select rectangle. Why you are selecting rectangle is because you are not just drawing a line like supply and resistance line. Even supply and resistance are not lines, though you use line when you are drawing supply and resistance. They are zones. So these are zones. Zones meaning that the price does not have to come down to a particular price before reversing. Once it gets to that zone, expects a reversal. So you select rectangle. Now you touch that point of the screen where you want to draw your demand zone. Okay, since we are using the last candle that formed at the turning point, that is the lowest candle that formed at the turning point, you touch the beginning of that candle. You can now see, you now pull it to the top. You now hold the rectangle and move it for adjustments. You can see the lowest candle there. That has been done. And now move it again to the left. You can see, yes, it might not be 100% perfect. You can increase the size of the lines of the rectangle. Just touch it and hold. It will bring out this. You now tick this pen sign, or that looks like edit. It will open. When you come to this pixel, you just increase the pixel. You select done. You can see the size of the rectangle. The rectangle is now bold. So you can also draw your line to join these other points. But the main thing, you look at that first candle, you look at that last candle, you make sure it's within that boundaries. So you see that these are zones. So here I've successfully drawn the demand zone. Let me zoom it in so that you can see the big picture. Can you see that? So this is a demand zone. What this is telling you is that whenever price comes down to this zone, you buy. You buy and set your stop loss few pipes below this zone, like I can say 10, 15 or 20 pipes below this zone, because you don't expect price to break this thing easily. So that is how you trade with the demand and supply zone. So this is one way. As I told you, there are three ways of identifying the demand zone. I've shown you how to draw it. So now I've shown you turning points, the lowest, using the lowest candle, which is this particular candle. You can see this candle here that looks like a hanging man. So that is a candle. We have drawn our demand zone within the boundaries of the lowest candle that formed before it turned, because that is the lowest point that the market got to before turning. So this is the demand zone. You can see this rectangle, this zone that this rectangle covers is called the demand zone. So the first one, as I said, is using the lowest turning points, identifying the turning points, and using the lowest for the demand zone, or the highest candle for the supply zone. So the next way of identifying it is consolidation. What do I mean by consolidation? I won't draw it. I'll just show you, since you now know from the way I drew it, you now know how it's drawn. Consolidation. A consolidation is a place in a market, or let me use simple terms, range. Like you can see this, where there's a range. You can see this point now. The market ranged as in kept moving within a particular price range without breaking it. So this can act, if now you can see after this place now the market started moving up. So this place acted as a demand zone. You can also come again with your, you can also come and draw your demand zone here. So let's just do that first. Rectangle. You can see, yes, you now draw. Now this is your device using consolidation method, which is the second method. Now if you follow this zone, this is the price range between 1.2424 to 1.2434. If you now look at, whenever the price comes back to that place, it bounces up again. You can see this is 1.2402, 1.2421. It broke that point a little bit, it bounced back up because that was a zone, a demand zone. So that is the second method. Now, what is the third method of identifying supply and demand zone? The third method is the gap. The gap method. The gap method. The gap method, what is a gap? A gap occurs when market closes and closes for the day, or most times it occurs overnight. A gap mostly occurs overnight when market closes and opens below or above the closing price of the previous day. For instance, if today is Thursday, market closes on Thursday. What I mean market closes, this is where the market closes. Okay, this is an example of a gap. You can see market close here, and the next day it opened below that point. Normally, without a gap, it's supposed to start. Look at the closing price here. The closing price here is 1.2459. Normally, it's supposed to open the next day on that price, but it came down. You can see a space. So this is a gap. Now this space, now if this gap, since this gap is down now, since this gap happened down, this gap will act as a demand zone. Now if price comes to this gap, it will have a bouncing effect on the price, since it's demand and supply zones that make this gap to happen. Since there's a strong force that pushed this market down. so that it did not start at the closing price. So now when the market comes back to this zone, it's going to push the price back. So this is going to act as a very strong supply or demand zone depending on the way the market moves. So the most important thing here now is that, let's go back to the first supply and demand zone we drew. The most important thing to note here is that now you can stick to the first one, which is the turning point. That is the most accurate one. So the most important thing to know here is that now, once price comes down to this point, it's going to bounce back, it's going to reverse. But as I told you, in Forex there's no hard and fast rule. If price tests these points up to more than 3-4 times, the fifth time is obviously going to break this point. So that is how supply and demand zones work, and that is how to draw it. So subscribe, click the subscribe button so that the next video I'll release, you are going to see it. Any video I release on this channel, you are going to see it. So hit the subscribe button. Also in the description below, if you want to contact me for private tutorials or signal, you can contact me through that description. So thank you for joining my class today. So the task I'll give you is that you should go to your trading application MT4 or MT5, draw the demand zone or supply zone, then paste it in the comment section. If I like it, you know that what you did is correct. So I'll obviously respond to all. Thank you.